bonds and stocks versus cryptocurrency. Welcome to my channel today. I will talk about bonds and stocks versus cryptocurrency. Before we get started, don't forget, like, share, subscribe to our channel. Digital currency has turned into a worldwide peculiarity, acquiring huge consideration, especially lately. Regardless of its pinnacle valuation stretching around $3 trillion out of 2021, the absolute worth of advanced monetary standards presently remains at roughly $1.7 trillion. As announced by CoinMarketCap.com, Bitcoin, which is worth more than $800 billion, stands out as the most well-known of these. This computerized dash for unheard-of wealth has drawn in a flood of financial backers, driven by the charm of fast gains, frequently exploring the scene with fluctuating degrees of information and plentiful good faith. Many investors have questioned the significance of stocks in their portfolios as a result of the cryptocurrency market's meteoric rise. Although stocks and cryptocurrencies both offer investment opportunities, their fundamental characteristics are vastly distinct. Stocks are ownership stakes in businesses that are secured by the respective business's assets and cash flow. Conversely, digital forms of money, as a rule, need substantial sponsorship. Investors looking to diversify their portfolios need to be aware of the differences between stocks and cryptocurrencies. Offering ownership in businesses with underlying assets and cash flow are stocks with a strong long-term track record. On the other hand, cryptocurrencies come with their own set of risks and considerations, so it's important to know everything there is to know about what's being bought in this dynamic and changing market. To avoid relying on speculation, investing in stocks or cryptocurrencies necessitates a comprehensive understanding. Here is a breakdown of key contemplations for each. Stocks. A stock addresses fragmentary proprietorship in a business, furnishing investors with a lawful case on the resources and income of the organization. The success of the underlying business determines a stock's value. Why stocks rise and fall. Stock costs vacillate in view of financial backers' appraisals of the organization's future achievement. Stock prices may be influenced by optimism in the short term, but the company's long-term trajectory is determined by its capacity to increase profits. Effective corporate securities depend on the supported execution of the fundamental organization. Cryptocurrency, digital currency like Bitcoin and Ethereum, is for the most part not supported by hard resources, barring specific stablecoins. Digital currencies offer functionalities like moving cash or executing savvy contracts naturally. Why cryptographic forms of money rise and fall. Dissimilar to stocks, digital currencies need backing from resources or income. Costs are basically determined by theoretical opinion, dependent upon unexpected changes. Cryptographic money esteem relies on the assumption that somebody will buy it at a more exorbitant cost from here on out, an idea known as the more noteworthy simpleton hypothesis of financial planning. In conclusion, cryptocurrencies are heavily dependent on speculative sentiment, whereas stocks derive value from the success of the underlying business. Understanding these major distinctions is urgent for financial backers to explore the particular dangers and prizes related with each sort of speculation. Experts of putting resources into digital money, conceivable support against government-issued money. Because it is not controlled by governments or central banks that might have an impact on inflation in traditional currencies like the euro or US dollar, the decentralized nature of cryptocurrencies can act as a hedge against inflation in fiat currencies. Potential for outsized increases. With several digital currencies having experienced significant price increases since their introduction, investing in cryptocurrencies offers the potential for substantial returns. Despite the inherent risks, investors' primary attraction is the prospect of substantial gains. Coins are multiplying. The digital currency scene has advanced, with new coins consistently presented. The extending assortment of digital forms of money, numbering in the large numbers, offers financial backers a more extensive scope of choices to browse. Wide interest in advanced monetary standards. There is a developing revenue in cryptographic forms of money from different partners, including financial backers, organizations, and states. Examples include El Salvador adopting Bitcoin as legal tender in 2021, and Tesla listing Bitcoin on its balance sheet. Cons of putting resources into digital money. Extreme turbulence. Cryptographic forms of money have displayed outrageous unpredictability in their somewhat short presence, driven by merchant feelings. Rapid and unpredictability in price fluctuations can result from a lack of backing and reliance on market whims. Online protection chances. Regardless of cases of safety benefits, digital currencies have confronted striking hacking occurrences, making it trying to recuperate taken reserves. Network protection dangers represent a tenacious gamble to financial backers in the digital currency space. No inherent worth. Digital forms of money need natural worth, as they are not upheld by basic resources or income, in contrast to stocks. Unlike cryptocurrencies, the value of stocks is typically based on earnings in the future. Regulatory dangers. Despite the fact that some nations have adopted cryptocurrencies, regulatory ambiguity and skepticism persist in numerous regions. Cryptocurrencies have been outlawed in China, and a number of other nations, including the United States, are enacting regulations. As a result, investors could face challenges due to shifting regulatory landscapes. While building your portfolio, there's a compelling reason to go with a select decision among cryptographic money and stocks, or different resources like securities or assets. The key is to decide the assignment that lines up with your gamble resilience and time skyline. Cryptocurrency. Because of its innate dangers, digital money is normally more reasonable for a little designation in your general portfolio, around 5% or less. If cryptocurrency experiences significant growth, even a modest allocation can have a positive impact on your portfolio. Furthermore, keeping the portion little fills in as security against a total misfortune in case of a slump. You might want to consider rebalancing your portfolio and lowering the overall risk of it by allocating more money to stocks if cryptocurrency becomes a larger portion of it over time. Stocks. Given areas of strength for the term history of stocks, an expanded assortment of stocks ought to frame most of your portfolio, particularly in the event that you have a long speculation skyline. For individual corporate securities, intensive examination is fundamental to accomplish ideal returns. A broadly diversified fund, such as an S&P 500 index fund, offers the potential for high returns without requiring extensive research if funds are chosen. Generally, adjusting your portfolio implies reasonably gauging the dangers and expected returns of various resource classes, adjusting them to your monetary objectives and venture procedure. In terms of security, both cryptocurrencies and stocks come with inherent risks, each with its own set of characteristics. Stocks, being upheld by an organization's resources and income, have a deeply grounded history of giving solid returns. They are dependent upon administrative oversight and advantage from financial backer insurances. Nonetheless, factors like market unpredictability, business choices, and worldwide occasions can influence the security of corporate shares. Digital currencies, while offering the potential for significant increases, present a more elevated level of unpredictability and need unmistakable resource backing. Cybersecurity threats and uncertainty regarding regulations are two additional risks. The risk tolerance of each investor and their financial goals will determine how safe these investments are. By and large, a comprehensively expanded stock portfolio is many times considered a more secure choice because of its inherent worth and history of conveying strong long-haul returns. While there is a potential for significant gains, there is also a risk associated with cryptocurrency investments. The decision among stocks and cryptographic forms of money relies upon a financial backer's gambling craving and venture objectives. Thanks for joining our journey into bonds and stocks versus cryptocurrency. Remember to hit that like button, share them with your friends, and subscribe for more high-flying content.